You would take this, multiply it by this, get 9,685, add the 315, and you get $10,000. That's how you figure out the present value of the minimum lease payments, which you then put on your books. And so the lessee's calculation of the present value of the minimum lease payment is basically the present value of the bargain purchase option, which they figured out is 315, working the opposite direction of what we did up here. And then the present value of the payments, they calculated as 9,685. And so the present value of the lease payments must be $10,000. So that's the way they got to that. They went the opposite direction of what the lessor did. So the lessor went one direction to figure out the lease payments, and the lessee went the opposite direction to figure out what the present value of the future cash flows was. Now it's possible that they're using different interest rates, and then the numbers will be slightly different. We're not going to ever deal with that in this class, but I'll be aware that that's a possibility. All right. Amortization schedule for the lease. So, the journal entries are going to be very similar to what we've already seen with the sales type and with the direct financing. We're going to do a couple of them on the next page, but we'll do this table first. So on 1/1/11, the outstanding balance is $10,000. On the same date, they're going to make a payment of 1940. No time has passed, so there's no interest associated with that. So the entire 1940 is going to reduce the carrying value. 1060 will be the new carrying value. All right, so let's think for a second what the journal entry would look like. So it's happening December 31st. In fact, do I have it on the next page? I do. No, I have the very last one. No. Let's go ahead and do the table, and then we'll do the very last one, and you'll see that as our example. 12/31. Hopefully, you've from our previous examples, you could probably figure this out. So take the 8060 multiplied by the market rate of interest, and we're going to get 645. That minus that is going to be the amount we reduce the carrying value by, 1295, 6765. And I'll just fill all these in, and then we'll talk about what we see toward the end. All right, and we're going to do this last line once you've copied all those down. Alright. Okay, we still have some left in our balance after we make our 1, 2, 3, 4, 5, 6 payments. So after we make all these payments, we get to the end, we still have 465. This is not an accident, because we still are going to make a bargain purchase option payment at the very end. And so here we're going to make a $500 payment. The effective interest on 462 is going to be 37. 463, and we're off by $1, but close enough. And now it's gone. Okay, so basically there's two kind of weird payments. The first one where there's no interest, and the last one which the cash amount is different because this is a bargain purchase price instead of our normal payment. Does everything on the table make sense? Any concerns? Do we notice that the effective interest method is still everywhere here? You can't get away from it. It's everywhere. We love the effective interest method, don't we? Of course we love it. How could we not? All right, on the next page, we're going to record, I think we just record the very last payment. So we're just going to record this date right here. All the other ones, I think you could probably recreate. Is that true?
It would be exactly the same.
And the only difference is that there would be no payables or receivables. So it'd basically just be these guys, but this would be interest expense and this would be interest revenue. But other than that, the same as this guy right here. And there'd still be depreciation, incidentally. We're going to figure out the depreciation in just a second because we're going to do that on the very last day. All right, so we're just going to do this guy right here. And it might be a good practice for you to go and see if you can do these journal entries. It might be good practice. So 12/31/16, this date right here. We're going to record those journal entries. So the first thing we need to acknowledge is that the lessee is the one that's depreciating this asset throughout its life. And since we're holding it through the end of 2016, we're making this bargain purchase option price, we're paying that, we're going to depreciate it through that year. So on December 31st, 2016, we need to record depreciation expense for the year. Let's figure out the amount. So the original amount for the asset is $10,000. The next question is, do we depreciate it over the lease term or the life of the asset? Life of the asset, why? Because with a bargain purchase option or with the transfer of ownership, you use the lease term. Why? Because basically we're going to own it all 7 years. So let's just depreciate it over 7 years. And that's what's going to happen here. So we're going to divide this by 7, not 6. Put a nice little note in your notes for this to remind you why 7 and not 6 would be great. And we're going to get depreciation of 1429. We're going to record depreciation expense and accumulated depreciation of 1429 and 1429. And then the next thing we're going to do, and this journal entry right here is going to look very similar to all of our other payments, but this is the bargain purchase that we're doing right now. And so when we make this bargain purchase, we're going to credit cash, $500. We're going to record interest expense that we had on that previous page of 37, and we're going to debit the lease payable for 463. All right, so now I have a question for you, and I'm going to tell you that that's all the journal entry we do. Well, why didn't we put the asset onto our books?
Because we put it on when we started the lease.
It's already there. We just don't take it off of our books is the key. Okay, so when we initially recorded this guy right here, oh, we didn't do it. So let's pretend like we don't have a good one to be an example. All right, we'll pretend like it's this one right here. When we put it on our books originally for $10,000, just like this right here, but $10,000 each, part of that is included the bargain purchase option, and so there's still assets sitting there on our books after. We just don't have to take it off when we have a bargain purchase option. And incidentally, if we had enough time, we would do full problems with all the journal entries for all of these, but there's no way we'd have time to do that for all of them. And so I'm only doing the essential parts of each of these so that you can see the essential parts, and the rest you're going to have to fill in on your own. So don't put that in our books because it's already on our books. We just don't have to take it off. And so for the lessor, they're going to record the increase of cash of $500. They basically just sold this asset to them. Did they take the asset off their books? No, it was already taken off their books on the very first day. They just don't have to put it back on. And so they're going to have interest revenue 37, lease receivable 463. All right. So now that we've thought about what happens at the very end of this particular lease, we haven't thought about what happened at the end of the previous lease that we did. So think about the direct financing lease, this big long problem we did just a little while ago. When we get to the end of this, do we need a journal entry on that last date to move the asset back? What do you think?
No,
Okay, the answer is no. Now tell me why no.
because you didn't take it off.
Okay, you did take it off, right here.
Well, at
We
least.
took it off of our books for 9989 and then they put it on our books for 9985. But at the end, we don't have to do a journal entry to move it back in this particular problem. Why not?
No residual value.
Okay, the assumption is we've used up all the assets now worth nothing and you just throw it in the garbage. Now if that's not true and it ends up that it's going to be useful for longer than 6 years, it's going to be useful for 7 or 8 years, then you wouldn't put the asset back on your books and you'd have a gain when that happened. But essentially you didn't think it was going to be worth anything at the end. The useful life was 6 years, the lease term was 6 years, so at the end of 6 years your expectation is worth nothing. Okay? This leads us directly to the next topic. So we've done a bargain purchase option.
Can you go back, how you got 7 one more time on the,
For the depreciation, come at that right there?
yeah,
Yes, so in this problem, the useful life of the grinder is 7 years, the lease term is 6 years. Because there's a bargain purchase option, you use the useful life. If there were not a bargain purchase option or transfer of ownership, then you use the lease term. Does that make sense? Okay. All right. So what I was just describing now brings us to our next topic, residual value. With the direct financing lease that we did earlier, useful life was 6 years, and the lease term was 6 years. Well, what if those are not equal? What if the useful life is 10 years and the lease term is 5 years, but it's a capital lease? What then? What do we do? And there's no bargain purchase option. That's where we get to the idea of a residual value. And we're going to find out that there are 2 types of residual values. There's a guaranteed residual value and there's an unguaranteed residual value. The residual value of the leased property is an estimate of what its commercial value will be at the end of the lease term. A guaranteed residual value, sometimes the lease agreement includes a guarantee by the lessee that the lessor will recover a specified residual value when custody of the asset reverts back to the lessor at the end of the lease term. This not only reduces the lessor's risk, but also provides incentive for the lessee to exercise a higher degree of care in maintaining the leased asset to preserve the residual value. So basically, this is put into the lease agreement to make sure the lessee takes care of the asset, is one way of describing this. Because let's say they ruin it and it's not worth the amount that it's supposed to be at the end, then the lessor loses out. But if there's a guaranteed residual value, then the lessee has to make up the difference if it's not worth that much at the end. Does that make sense? So it's a guaranteed residual value. An unguaranteed residual value, a lease agreement doesn't say anything about the residual value. This is referred to as an unguaranteed residual value. In the case of an unguaranteed residual value, the lessee is not obligated to make up payments other than the periodic rental payments. They make the rental payments and they give back whatever is left, and that's it. They don't have to do anything. They have no other responsibilities other than to give it back when they're done. Okay, so that is an unguaranteed residual value. A lessee guaranteed residual value is included as a component of the minimum lease payments for both the lessor and the lessee. Okay? A guaranteed residual value looks a lot like a bargain purchase option. And at least in the figuring out the numbers, it looks very much like a bargain purchase option. Because there's this residual amount that's guaranteed, which once again, we basically pretend like it's a lease payment. Either you have to give back an asset worth this much, or you have to give us cash worth this much, one or the other. And we basically, it looks a lot like a lease payment, which looks a lot like our bargain purchase option. An unguaranteed residual value is not included in those things. But it is part of the lessor's gross investment in the lease. And so we're gonna see some asymmetry between the two because of that. And you'll see what we mean when we do our example. If the lessee obtains title, the lessor's computation of lease payments is unaffected by any residual value. In other words, if there's a bargain purchase option, or if there is a transfer of ownership, who cares what it's worth at the end for the lessor? They don't get it back anyways. So it becomes irrelevant if either of those two things are true. So we ignore the residual value if ownership transfers. So it doesn't matter in that case. If the lessor retains title, the amount to be recovered through periodic lease payments is reduced by the present value of the residual amount. On the other side of the transaction, the lessee considers the purchase price of the asset to include, at minimum, the present value of the periodic lease payments, an amount due to the residual viewed as an additional payment if there's a guaranteed residual value, and then not if there is not one. 20 minutes. Can I get through this problem in 20 minutes? Yes, I can. Actually, let me look real quick, see how much we have left. We've made good time today. That's what happens when you don't have a 45-minute quiz at the beginning. Which is about how long that quiz normally takes. Well, maybe 35 minutes. Alright, I think we've made good enough time that we don't have to actually do this problem tonight. Does that sound okay to everybody?
Yeah.
Is anyone sad that we can't do it tonight?
Yeah.
So here's the